whole lot of macroeconomic news due in the coming week, although what there is will focus on the UK. On Monday the 6th of February, we'll see the latest Purchasing Managers Index, or PMI, from the UK construction industry, courtesy of data compiled by S&P Global and the CIPS. Remember that with these surveys, a score over 50 is indicative of growth, one below 50 of a slowdown or even a decline in activity. The last score for construction was 48.8, the first below 50 for 4 months, so economists will be hoping for improvement, especially as the flash readings for manufacturing and services last month both came in below 50 to suggest the UK is indeed teetering on the brink of a slowdown or even a recession. Now, on that subject, we'll get the latest GDP growth numbers for the UK on Friday the 10th, and they will cover the 3 months that ended in December. According to data for the Office for National Statistics, the UK economy shrank by 0.3% quarter on quarter in the third quarter from July to September. A second consecutive sequential decline is the technical definition of a recession. So let's see what the numbers say, although a decent Christmas for retailers and retail sales may give some hope that the UK did duck a recession in the last quarter, if only just. The year-on-year growth data also suggest a slowdown in UK economic activity, although I would add this. Remember that GDP data is backward-looking, while stock markets are forward-looking discounting mechanisms. So how much use the ONS data will be from an investment point of view is hard to discern at best. It might just tell us what share prices know already, judging by the hammering handed out to cyclicals and consumer-related stocks in the middle of 2022. On the corporate front, we've got a busy schedule of trading updates, half-year and full-year results. Companies which may be worthy of further analysis include the following, although some of these dates could yet still be subject to change. BP and SSE on Tuesday the 7th, Smurfit Kappa, Barratt Developments, DCC and PZ Cussons on the 8th, British American Tobacco, AstraZeneca, Compass, Redrow and Watches of Switzerland on the 9th, and Victrex, Lancashire Holdings and S&U on the 10th of February. But for all of the potential impact of those names, the company which could just cause the biggest fuss in the week ahead is Unilever. The food and household goods giant, best known for brands that range from Dove to Domestos, Hellmann's to Knorr and Magnum to Marmite, is due to report its fourth quarter and full year results on Thursday the 9th of February, having just announced that current non-executive director Hein Schumacher will take over as chief executive from the retiring Alan Jope in July. The shares are up modestly over the past 12 months, which have nevertheless been a tumultuous year for the FTSE 100 member. Amongst other things, the company failed in a £50 million bid for the firm that is now Haleon, when it was still owned by GlaxoSmithKline or GSK and Pfizer, attracted the attentions of activist investor Nelson Peltz, who's now got a seat on the board, downgraded profit margins for 2022, launched a €3 billion share buyback programme, was attacked by a major shareholder for virtue signalling and focusing too much on sustainability, not enough on profit and selling its products, announced that boss Alan Jope would indeed retire by the end of this year, and then ended the year on a relatively high note by raising its sales growth guidance and holding its downgraded margin guidance alongside October's third quarter results. And it's in the context of that October outlook statement that these fourth quarter and full year results will be initially judged. Mr. Jope has stated that full year underlying sales growth for 2022 will exceed 8%, and the analyst consensus is now looking for an 8.8% increase. Note that analysts expect to see double-digit percentage increases in pricing offset volume declines as Unilever flexes its brand power to compensate for how cash-strapped consumers may be trimming back on spending, either by buying less or at least trading down through brands. Investors will also look to volume and price trends by geography and in terms of the five-pronged business structure introduced after a reorganisation in early 2022. Those now new reporting business units are beauty and well-being, personal care, home care, nutrition, and finally, ice cream. On a headline basis, by the way, analysts are looking for a 14% increase in stated sales to €59.9 billion. That includes the positive effect of currency movements and a small negative impact from asset disposals. Underlying operating margins is the second forecast that Mr. Jope gave, and he said that they will come in around 16%. That's down from 18.4% in 2021. Those numbers translate into analysts' consensus estimates for underlying operating profit of £9.65 billion, pretty much flat against 2021. Stated operating profit, including around €1 billion of restructuring costs, the impact of acquisitions, disposals, and asset write-downs, well, stated numbers are seen reaching €8.9 billion by analysts, up from €8.7 billion in the prior year. After those headlines, analysts will then look for any guidance from Mr. Jope for his final year in charge. The current consensus estimates are as follows. Underlying sales growth in 2023 of 4.3%, and that's 5.3% price growth, with then the rest coming off in volume. A 2.7% increase in headline sales to €61.5 billion. An increase in the underlying operating margin to 16.6%. An underlying operating profit of €10.2 billion, with a headline operating profit of €9.5 billion. Finally, attention will switch to cash returns. As already noted, Unilever is running a €3 billion share buyback programme, and the first two €750 million tranches of the programme have been completed. Analysts and shareholders will also look to the dividend. In 2021, Unilever paid out 4 straight quarterly dividends of 42.68 euro cents, and it's offered 3 more of the same for 2022 so far. Taking into account foreign exchange movements, an identical sum for the fourth quarter should take the full year payment in sterling terms to around 147p, no great change from 2021's 146p a share. I hope that you and your families are in good spirits and keeping well. Thank you for watching, and I look forward to seeing you next time.